Okay, Assalamualaikum warahmatullahi wabarakatuh. Right, after we did the topic of risk and return, so now we go to the next chapter, which is on chapter 4 on financing decision and efficient market hypothesis, right? Okay, so as a starting point, right, we look at the financing decision first. What is financing decision? I think this one I already explained to you, right, in the first chapter last time. Okay, basically, financing decision, right, it includes how much debt or how much equity to sell, what types of debts and equity to sell, and when to sell, right? When to sell the debts and equity. So this is the financing decisions all about. The decision that involve, right, involve um, the financing of the company's assets or company's new projects. Okay, so whether the company, that means the company has to decide whether to use or to issue debts or to issue equity in order to raise the fund, right? And then the company needs to know what types of debts or what types of equity is it. If it's a debt, right? Company has to decide whether to borrow the money from single entity, which is the commercial bank, or from a number of entities like bondholders by issuing bond. Okay, or if the company decides to use equity, right, in order to raise the fund, then the company has to decide what types of equity that the company wants to issue, whether to issue an ordinary share or preference shares. And then they have to decide when is the right time to sell. Okay, right. Next one, we go to the slide, which is here how to create value via financing decision. So in order to make a financing decision, the finance manager must make sure that financing decision will create a value to the firm. Okay, will create a value to the firm. Because why? Because when the value of the firm is increased, then automatically the value of the shareholders' wealth will also increase. Okay, right. So how is it can be done? Right. Firstly, right, the financial manager might uh, form a package of security, right, where they can sell that security at a higher price, right? They think that they can fool the investors by doing that, right? So for example, a firm would issue a more complex security such as a combinations of stocks and warrants, where the shareholders can detach this warrant or can use this warrant for um, buy or for exchanging the for companies securities. Okay, the firms may be able to get more than the fair value if the investors are misguided. Okay, right. However, okay, we must bear in our mind, right, if the market, right, our market is efficient, then the financial managers cannot uh, fool the investors or cannot sell the stocks at higher price. Why is that? Because the stocks or the securities are actually appropriately priced at all times in the efficient market. Okay, because the securities are already at fair value or correct price. Okay, and then there is an empirical evidence which suggests that it is not easy, right, for the financial manager or company to fool investors consistently, right? This is one way to create value by fooling the investors, create value through the financing decision. However, it's not easy, right? Because the market is always the market price is always at correct price. Okay, another way is by reducing the cost or increasing subsidies. So the companies can create value through the financing decision by reducing costs or increasing subsidy through the securities issuance. How is it? Right? If the company plan, right? If the company plans to increase the firm's value, okay, and then the company wants to what is it, increase the firm's value by getting the tax advantage or tax reduction, right? Then the company can issue debts. Why is that? Because debts, when the company issues debts, the company will obligated or will be committed to pay the debt holders or the creditors the interest amount. So this interest amount will increase the expenses of the company, and then there will be less debt, so less profit, right? Taxable income will be lower, so therefore the tax payable will also lower. Okay. Okay. Right. The next one, create a new securities. Okay, a new security means that a new types of maybe a new types of stock, a new types of financial instrument other than a normal stock. Then the company can create a new stocks or a new security to be issued to the investors. So sometimes the firm can find a previously unsatisfied clientele, that is the shareholders who cannot be satisfied previously, right? And issue new securities such as zero coupon bond, convertible adjustable bond, convertible adjustable preference stock, zero coupon convertible bond at favorable prices. So these new securities cannot easily be duplicated by combining existing securities. Okay, that means they create a unique securities. Okay, that cannot be uh, cannot be competed or cannot be duplicated by the competitors. So therefore, you can take advantage of this, right? Of this issuance of a new or a unique security here, right? And by selling them or issuing them at higher price, so then you can create the value of the firm. However, it only successful in short term. Why is that? Because in the long run or in the long term, right, this value creation is relatively small. Why is that? Because slowly, right, as time goes by, right, this new security will be duplicated by the competitors, okay, in long run. Okay, now we go to the second part of this topic, which is the efficient capital market. Right. So first thing first, we need to understand the definition or the meaning of the efficient capital market. Right. So here is a description of this efficient capital market. We go to the first point here. You can see that an efficient capital market is one in which, right, stock prices, okay, in which the stock's prices fully reflect available information. Okay, right. So here we can see that done. Okay, you can see here the definitions of efficient capital market, right, is the market which the stock's prices fully reflect. What's the meaning of fully reflect? So fully reflects, that means fully absorb. Okay, absorb. What is it the stock's price absorb? Okay, fully reflect or fully absorb available information, whatever information they have in the public. So all available, fully absorb all available Okay, information. So where the information comes from? So that information comes from announcements or new information, right? Information that comes from announcement made by the company plus or new information released by the company. So where do you get this information? That means you get this information from newspaper, right? Internet, right? And then what else? Magazine, right? If you want to know financial performance, then that information or any new information also will be stated in the annual report. Okay, so these are the information that may or that are absorbed by the stocks price. Okay, because of this information, right, the price immediately adjusts. Right, that means once the stocks price, right, once the stocks price here, okay, fully absorb or fully reflect, okay, all available information that are from announcement and new information which you can get from the annual report, newspaper, internet, etc. So this will make the stocks price to react, to respond, to adjust, or maybe the simple word is to change, right? Quickly, immediately. That means quickly, okay, or immediately, okay, immediately, or instantaneously. Any vocabs you can use as long as it gives a same meaning. Instantaneously, instantaneously, eh? Alright. Okay. So that is describing the efficient capital market. Okay. So when the market becomes efficient, right? So the stock's price is more what accurate or is more uh, what is it? Is more that means the stock's price will be fair value. Okay. So here the stock's price will be at a fair price. Okay, and correct price, right? And there is no more changes. There is no more changes in the stock's price. Okay, why? Because this stock's price already absorbed this information, so no more changes. So it will constant after the announcement. All right. So if we show on this one, right? So that means okay, efficient, right? Capital market is where, right, the stock's price, okay, fully absorb or fully reflect, okay, fully absorb, okay. What is it they absorb or reflect? To all available information, all available information, right? That you can get these informations from newspaper, public information, right? Okay, newspaper, internet, annual report, okay, and etc. Which you can get the information publicly. Right, so once the stock's price fully absorb this information, then the stock's price will what change quickly, right? Stock's price change quickly, okay, or immediately. Okay, and there is no further changes in the stock price. Okay, and the stock's price is correct. The stock's price is at a correct price. Okay, or at a fair price. Okay, so that is the whole story of this efficient capital market. So, alright, so if we show it in the diagram, let's see, so let's say, right, currently, right, this is the current stock's price, 2 ringgit. So here, so currently the stock's price is moving within the range 2 ringgit 5 cent, 2 ringgit 1 cent. So we average it out, let's say 2 ringgit, okay? Right, so now at on one day, right, which is considered as an announcement day. Let's say this is our announcement day, which is 0. So let's say there is a good news of this company, which is the company has announced, right, has made an announcement, okay, that the company is going to pay or is going to increase this year's dividend, okay, to the shareholders. Right, so dividend increase announcement. So dividend increase, then you look at the market, what happened to the stock's price. If the stock's price is quickly absorbed, okay, right, quickly, right, fully absorbed and quickly change to the new stock's price. Let's say stock's price now become 6 ringgit. Right, so and then there is no further changes in the stock's price after the announcement day. Why there is no further changes in the stock's price after the announcement day? Because the stock's price here from 2 ringgit it's fully absorbed this information. That makes, all right, the stock's price to increase to 6 ringgit and no further changes because the price already absorbed this all information. Okay, right, so that's why stock price becomes 6 ringgit. Okay, so this is the shape of the stock's price movement in the efficient market. Okay, it's like a Z shape. So this is the stock's price movement in the efficient market. Later on, we will look at what kind of the stock's price movement, right, that will describe inefficient market. Okay, right. We go to the next slide. Okay, right. So having that understanding, okay, in the understanding of the efficient capital market description or definition. So here we can conclude the premise of efficient market hypothesis is that what are the premises or the criteria or the features? First, the prices reflect all available information. Okay, right, provided or any available information, okay, which are publicly known, in other words, okay, then the stock's price reflect that information. And then stocks price fully incorporate known information. Right, fully incorporate known information, that means the information that is available already available in the newspaper, magazine, etc. And then again, the stock's price must change rapidly. Okay, okay. Prices change rapidly. This one, prices reflect all information. Maknanya dalam kes ni fully reflect, right? And then stock's price change rapidly to the known or knowable information, and then information disseminates rapidly. Okay, and finally, day-to-day price changes will follow in a random walk theory, right? So random walk theory here means the stock's price in the efficient market is unpredictable. Okay, unpredictable. Okay, right, so these are the premises of the efficient market hypothesis. All right. Then, if the market is efficient, then what are the implications of this ENH to both parties here, investors and firms? Okay, so like I said earlier just now, right? Okay, when the market is efficient, right? So when the market is efficient, okay, right? That means the stock's price, what happened? The stock's price fully absorb or reflect all available information. And then what else? The stock's price quickly absorb that information. Okay, absorb the information and quickly change. Okay, the stock's price quickly change. Okay, and then the stock's price, okay, will be at a fair price, or you could say that at a correct price. So this is what happened to the stock's price in the efficient market. So since the stock's price is already at a fair price or at a correct price, so that means the implication to the investors, okay, right, or firms, like these two parties can only earn a normal profit. How is it? So let's say just now our example, okay, here, right? So the stock's price just now has changed, right? Has changed, okay, from 2 ringgit. It's now from 2 ringgit, and then due to good news today announcement, the stock's price quickly respond and quickly increase to the new price that makes the stock's price becomes 6 ringgit just now. Okay, so that means this is the correct price. Market is efficient and this is the correct price. So what happened? So that means the investors cannot sell its stock or their stocks at the price higher than 6 ringgit. They can only sell the stocks at 6 ringgit only in order to get a profit, and that profit is called as a normal profit. So investors cannot make, so therefore investors cannot make what? An extraordinary profit. They can only make a normal profit. right? Only a normal profit can be made by the investors if they want to sell the stock. If they want to buy the stock, they cannot buy the stock at the price of lower than 6 ringgit, right? They have to buy the stock at this market price of 6 ringgit, not lower than this. If you want to sell, you cannot sell at higher than this 6 ringgit. Understand? Right. What about firms? The issuing company, right? The company which issue the stock. Let's say companies want to raise fund. Okay, right? They need the additional fund for new project, for a new project. So what happened? The company plans to issue equity, okay, in order to raise the additional fund or required fund. So can firms sell the stock at higher than 6 ringgit price? The answer is no. Firms can only sell the stocks or issue its stocks at 6 ringgit. So that means again firm here also cannot make an extraordinary profit. Okay, they can only earn a normal profit. Alright, okay, so that's about it. Alright, the implications of the efficient market hypothesis to investors and firms. Okay, so here firms should expect to receive the fair value of this for their securities they sell. That means 6 ringgit just now. Okay, fair means that the price they receive for the securities they issue is the present value. So firms cannot profit from fooling investors in an efficient market. Okay. Another one is here in the first point, investment in financial securities here now are zero NPVs project. So therefore, investors should expect to obtain a normal rate of return. Okay, this one. Okay, and the firm should sell their stock or security at a fair price. Let's say 6 ringgit just now. So these firms cannot sell at a price of higher than 6 ringgit. Okay, so those are the implication of the efficient market hypothesis to both parties that are investors and firms. Okay, right. We need to know the inside information. So what is inside information? So sometimes it is called as a private information. Okay, so this is actually the information which possessed by people in special position inside the company or insiders trading, in other words. Right? That means insiders trading, that is buy and sell stock using or based on the private information. Private information or inside information. So that's why we call it as insiders trading. Okay, for example, let's say here and invite this is a situation where if the investors before we go to example, so if the investors if the investors okay, have inside information about the company, so the investors can make use, right, they can use that information, the inside information, okay, obtained from, right, from someone who possess that information, right, of the company, right, can use the inside information obtained, okay, to make an extraordinary profit. Okay, right, so and investors can profit from inside information, right, by investing in the company's stock if he or she obtain a good news, right, about the company, or he or she can sell the stock, right, when he or she obtained bad news about this company. For example, okay, currently, okay, example just now, let's say our example previously, right? Currently, the stock's price is 2 ringgit, and due to good news, right, increased dividend or whatever good news information released by the company, and it makes the stock's price fully absorb that good news information, right? And then the stock's price reach a new price and no further changes, so it becomes 6 ringgit. So this is the fair price here. So now let's say you have someone or your best friend or your cousin or whoever you have in the company, right? They give you some information about the company. So for example, your friend or your best friend, right, has informed you that this company is going to bankrupt, okay, sooner because this company has a critical problem, right? A very what bad situation in the company, okay, that right now is happening actually. Right, so most probably, right, the company is going to bankruptcy. Okay, going for bankruptcy. So then you get that information, first-hand information, right? So what will you do? You will quickly sell the stock at this current price, 6 ringgit, before the companies go bankrupt. That makes the stock's price to drop significantly in future. So you will quickly react to that inside information. You must quickly react or you must take action quickly. How is it? You may sell that stock at 6 ringgit, the current market price. Okay, then you can make a huge profit before these stocks or this company collapse. So that is how the inside information would help you to make an extraordinary profit. Okay, all right. So that is about inside information. Now we go to the stocks price movement. Okay, to the new information in both market, efficient market and inefficient market. Okay, right. Look at this graph or this stocks price movement. Okay, so let's say this is the current price. Let's say 2 ringgit. Okay, so before the announcement day, so the announcement day is actually zero here. Okay, we drag the zero to here. Okay, so before the announcement day, right, or before any new information released about this company, right, the stock's price is moving within the range here of 2 ringgit, right? There are 2 ringgit along this line until the announcement day. So let's say this is the price from Friday to this morning, Monday morning. Okay, and then afternoon today, which is Monday afternoon, the company has made an announcement that there is new project that will be in Vietnam. Let's say, right, a merger. Okay, so let's say merger announcement. Okay, which is the new project of the company, for example. And then we found that the stock's price, okay, quickly respond and fully absorb this information. Okay, fully absorb this information, and then it will make the price, right, stock's price quickly change to the new price, and there is no further changes in the stock's price. Okay, so like a Z shape. Okay, so if this is the stock's price movement in the market due to the announcement of merger or takeovers just now, then that means the market is efficient. Right. The analogy here is like this. Let's say I inform you, okay, this morning I have what stomach ache. I'm not feeling well this morning. So if you are efficient, you may react quickly to my information here. That means you may give some quick response. Oh, ya ke madam, right? Betul ke madam? Are you okay now? So that is a quick response from you, right, to my announcement here. So that means you are efficient. Okay. Right, now let's go to another stocks price reaction, right, to this information. Okay, let's say, right, the stocks price, currently is at 2 ringgit, okay, here, until the announcement day here. So this is the announcement day. And let's say now, okay, the stocks price, okay, due to that new information, right, the stocks price here move slowly, right? The stock's price reacts slowly. That makes the price increase sikit-sikit. In other words, the stock's price not fully absorb and not quickly respond to this information, right? It responds slowly, and then therefore the stock's price increase slowly, right? From 2 ringgit, it increased to 2 ringgit 1 cent, 2 ringgit 2 cent, 2 ringgit 3 cent. Okay, let's say this new price is 4 ringgit. Okay, right, and then slowly increase up to 3 ringgit. Okay, you can see that there what changes, right, further changes in the stock price after the announcement day. The announcement day is here Monday, let's say, and on Tuesday the stock price still changing. Wednesday still change, keep on changing until the stock price reaches one price here. So the stock price movement is like here, like this one, and then they move slowly, right, and then this one. This movement, it shows that there are further changes, right? There are further changes in the stock's price after the announcement day. So then it reaches fair price of 4 ringgit. So this stock's price movement representing inefficient market. That means the market is not efficient. Okay, because the stock price move slowly and not fully absorb and not quickly absorb. Okay, kalau kita punya market efficient, dia akan terus berubah ke price baru. Okay, dia dah tak ubah dah lepas tu. Dia dah fully absorb. Okay, the next one, what about in another case? Okay, right, currently the stock's price, okay, take the black one. Okay, right, currently the stock's price is at 2 ringgit. Okay, and then good news, right, of announcement of merger or takeovers or maybe increased dividend. So the shareholders who are too excited, okay, they make the stock's price increase, right, but then drastically and then slowly decline. Dia tak increase terus stock, maintain. Kalau macam ni, the stock price movement, that means the market is efficient. But the thing is that the stock price is not moving like this, in this way. So the stock price is actually, right, it increases quickly, right, and drastically, very much increase, yeah. So maybe from 2 ringgit, it increases to 6 ringgit. But slowly, on next day, Tuesday, Wednesday, Thursday, until Thursday, let's say, it declines and it reaches the new price. Slowly decline and then reach the new price and then constant. So the stock's price move like this. Okay, increase drastically, overreaction we call it, and then slowly decline. So that means you can see here, right? That means you can see here after the announcement day, the stock's price keep on decreasing or changes. There are further changes in the stock's price after the announcement day, right? This one also. Okay, so after the announcement day, the stock's price keep on changing until the stock's price reach the new price. Then baru dia constant. So if this is the kind of movements of stocks price, that means again the market is not efficient. Okay, it must be a quick and fully absorb that information, and there is no further changes in the stock's price. That means then we call it is efficient. Okay, so this is how the stock price reaction to a good news. Let's say bad news. Okay, here. Right, currently, let's say currently the stock's price is at 4 ringgit. Okay, so this is the stock's price movement before the announcement day. Right, maintain, right? It's moving within that range like this, but we average it out, then it's equals to on average 4 ringgit. And then on the announcement day, let's say the announcement day, the company announced what? Announcement day. So what kind of announcement? Let's say bad news of dividend cut, dividend omission. That means no dividend this year due to COVID-19, right? Company cannot get more returns and earnings, therefore company cannot pay dividend this year. So there will be dividend omission. Okay, so the shareholders are not getting any income in the form of dividend from this company. Okay, right. What happens? So stock price here maintain 4 ringgit, and then once the bad news announced, so the stock price fully absorbed and no further changes in the stock price. Okay, fully absorbed and quickly absorbed. Then this is we call as efficient market, efficient capital market. Okay, so what happened if there is a slow motion, like slow mo? In other words, nowadays terms slow mo, and people right call. Okay, now currently 4 ringgit, and then companies what make announcement of dividend omission, but stock price slowly decline. So that means there are further changes after the announcement day, right? Announcement day here, and still changes, keep on changing until it reaches the new price, which is let's say 2 ringgit. Tapi lambat. So this slow response representing inefficient market. Okay, what about overreaction due to bad news? Very sad, very reluctant, so many, what is it? Feelings, right, that influence the actions to be taken by the shareholders that will make the stock's price drastically decline. So here the stock's price drop drastically, okay, from 4 ringgit on the announcement day, but then it slowly increased. After the announcement day, stock price still changing. It's not constant, changing, increase, and then decline back until it really reaches the price. Okay, price that remain constant after that. After few months, after 1 month, okay, or after few weeks, okay, then we can get this constant stock price. So if this is the case, again, this is also representing inefficient market. Understand? So if the stock price moves slowly to the new information, inefficient. Right, that is delayed response. If the stock's price quickly respond, but what keep on changing after the announcement day, then again this is also inefficient. Okay, right. Now this is the conclusion. Right. So the reactions of stocks price to new information in the efficient market and in the inefficient market. Right. In an efficient market, okay, right, the prices respond instantaneously. This is what I mentioned just now. Instantaneously, quickly, rapidly, right, immediately to any new information. For example, just now, dividend omission, earnings announcement, dividend increase, takeovers, and fully reflect that information. That makes the stock's price to move in this shape. For good news, right? Or for bad news, so in this shape. So it's representing efficient market. Right, after the public announcement day, there is no further changes. So this is what we meant for this part. No further changes take place in the stock's price after the announcement day. Why? Because the stock's price has fully absorbed the information. Dia dah absorb semua dah, tak ada apa dah tinggal. That's why stock's price become like that and constant. Right, the delay response. So what's the delay response? Delay response is referring to a slow response lah, in other words. Okay, which is, if it's a good news, the stock's price slowly increase. If it's a bad news, the stock's price slowly decline. So this is slow response. Okay, slow response that representing what? Inefficient. Okay, so delayed response, underreaction or overreaction to new information would suggest that the market is inefficient. But then how long it's normally take, right? The stock's price normally take to absorb, fully absorb the information. Normally based on the empirical evidence, the delay response usually takes 30 days to fully absorb. That's why mengambil masa yang lama untuk fully absorb, buatkan dia sampai dapat harga yang fair. Okay, so after 30 days, then the stock's price remain constant. Why? Because the stock's price has fully absorbed the information, but then very slow, which is 30 days. After 30 days, that is representing inefficient. If it's overreaction, right? If it's overreaction, okay, so like this. Okay, if it's a good news, then it's the stock's price increase, but then slowly decline until it reaches the fair price. So it takes longer time, okay, to really absorb that information. They quickly respond, but then to absorb the information slowly. Okay, same here. Stock's price declines, but then slowly increase. So this is also inefficient. Why is that? Because there are further changes in the stock's price. Okay, further changes in the stock's price after the announcement day. Okay, so I hope you get a clear picture about this definition. Okay, right, the next one, we will go to the different types of efficiency. Okay, so the different types of efficiency is based on the different response rate to the information, right? So different differential response rate will results in different market efficiency, right? So in the next video, I will explain about these different types of efficiency in detail. So we stop now, all right, and I'll continue with the next part after this or later on. Thank you, class.